Thanks for tuning in to Talking Point Unfiltered. We try to speak to some of the best minds in the investing world and in the business world on this long conversation. And it's an absolute delight to welcome on the show today a very highly regarded but a reticent media investor, if you will. Somebody who doesn't come on media very often but is very well known in the investing circles for his high acumen and a very differentiated investing style. Absolute delight to have in Mr. Govind Parikh on the show. Govind bhai, thank you so much for agreeing to do this.
Thank you, Neeraj. It's my pleasure.
No, I can tell you it's our pleasure, and it's going to be the pleasure of the viewers and the listeners over the course of the next 30 to 45 minutes that we speak to you, because what we glean, what we will learn from you will be terrific. For the very few who might not know about your investing style, Govind bhai, can you tell us a bit about yourself? Maybe your early days, maybe how you framed your investing journey, and what kind of an investor are you, if I can simply put it?
Basically, I started investing from 1978, and 1980 actively I was investing, and then started investing till then I became a stockbroker in 81, and till 92 I was very active stockbroker. We didn't have too much money, so I was busy making money, trading and doing, running around all the time. And after 92, we slowed down a little bit, and I realized that it is more long-term investing that pays. So that made me look at long-term investing, and my gurus in Bombay, Shri Naresh Khanwala and Kisan Choksi, they have guided me to be a long-term investor. So I used to meet a lot of companies and factories along with them, and I decided that this is the way where your wealth can grow in a big way.
So you've been investing for a long time, Govind bhai. You would have seen various cycles, 2000, 2008, 2020. What is the worst corrective move that you've seen, and what are the lessons that you draw from that which might have relevance even for the current cycle?
Basically, I have seen the crash of 1984 also, just before Indira Gandhi's death.
I didn't see that, yeah.
But 2000 crash was a dot-com crash, and it didn't affect us much because we were having a very small portfolio, and also people, used to add just a .com to an internet company, and the valuations were very high, so it corrected quite a lot. But then, our size was small, and it didn't hurt us much because we never invested in companies which we didn't know. So basically, 2008 crash was the worst crash I have seen. In 2008 crash, the Nifty crashed about 50% in 6 months, whereas my portfolio came down by about 75%, because the shares we were owning were all blue chip companies, very good companies, but they were quite illiquid stocks. And there was no market for that. When the whole market is in red, nobody was caring for these kind of stocks. So we took a big beating there. Fortunately, we were not borrowed. We never invest in the market.
No leverage.
No leverage. But we took a big beating, and so we held on to whatever shares we were. And unfortunately, I didn't have enough cash to buy at those levels, which are so attractive. Subsequently, the lesson that I've learned from this crash, the most important lesson is you must have some cash with you. You cannot have everything in the equities for these kind of things to come. And you should also, expect the unexpected to happen. So that was a very big lesson in 2008. And after that, we've decided that my son Chinmay is working with me. So we both decided that we should have at least 10% cash in our portfolio. And it has been pretty good. So after that, 2020 crash was a COVID crisis. That crisis was actually a life crisis. It was not just the stock market, but everything was down. People were not sure whether they'll live or not. I also lost a couple of friends and 1 or 2 relatives also. So it was a lot of panic was there, and a lot of blood on the street was there. Stock market was, nobody was bothered to look at it. But then the valuations were very, very low, and with our experience of 2008 crash, we had a lot of cash at that time. So that money we invested, and and it has really helped, because after 2020, if you see, only the last one or 2 months the market has come down, but otherwise the market was only going up and up and up.
Got it.
So the lesson that I've learned is that you should always expect the unexpected to happen, and you should always have some cash with you in the worst times like this.
So even if you like a business a lot, I'm guessing you are saying that if it goes up quite steeply, in a slightly unemotional fashion, you are happy to trim down some of that position. Would that be a fair assessment, sir?
Yes, we do that. Whenever the market goes up crazily, valuations are crazy, and people feel there's no tomorrow, you're not going to get stocks tomorrow, or you have to pay for looking at a share certificate or demat certificate, and when taxi driver is asking you and everybody is asking you kya lena hai, that's the time I think we sell some shares also.
Okay, you do that.
Even if the best of the best companies, we sell a little bit.
Okay.
This is basically from risk management point of view.
Got it.
Because in the cash collected is always going to be helpful.
Got
So
it.
that's
Sir.
how we do.
Okay. And one more question on this topic. What differentiates a normal correction from a very steep bear market like correction? When do you deploy this 70-80% of cash, and when do you feel that, oh, let's stay back because the correction could be a lot deeper, because this could be a bear market and not a V-shaped correction? Because everybody who's come in Govind bhai after 2020 hasn't quite seen a bear market of sorts. Maybe this is similar to 2022, but the market has always had a V-shaped rebound. So to your mind, what is the difference between a bear market and a small correction?
See, basically, a small correction takes place when the economy is doing extremely well.
Okay.
And the valuations are going up too steeply. Maybe they are discounting 2, 3, 4 years earnings. So that is a kind of correction which is a temporary correction or a stock market correction. At that time, we try to sell a lot of shares which have really gone absurd levels. Some of them we sell. Some of the bad, always every portfolio has got some bad shares. So those bad shares we try to get out first.
Okay.
And we wait for the correction, and then we buy back again the shares. Good shares also sometimes we sell, because it is just to take the advantage of the market situation. Like for example, if you take in 2000, I don't remember the date, 2015 or so, we sold Bosch. Now the price was around $20,000, and we thought that it should be worth $15,000 in those days. I had bought Bosch in 80s, at some $300-400.
Sure.
And every year we were visiting the company and we meeting the management and all that during AGM. And so I started selling from 20,000. I went on to sell up to 28,000.
Wow.
28,500, and we sold it. And then because it's the best of the best companies in the world. But the reason we sold is the valuations were too high, and also it is one of the 6 Bosch companies. So this 80,000 crore market cap was too much for that. So we booked some profits there. That's the only sale which I have done correctly, where the prices have come down, and I think it has reached that level recently only now. But otherwise, most of the times we do very hurried sale. We don't wait really, because we are a very scared investor.
Okay.
I'm a very scared investor, because I've seen so many periods. So most of the times we do that mistake.
Okay, but you don't have a regret that despite the fact that you make the mistake of selling early, you still want to ensure that you sell and keep that 10% cash. It's okay to let go of some of the gains.
Yeah,
Future gains.
Sometimes yes, but sometimes you let go a lot of it. That is a different thing. But yeah, generally we follow the principle, sell, regret and grow rich. After we sell, prices go up also in the bull market, the height of bull market. You can't stop anybody's hands and say that, okay, hold his hands and say, don't buy, this is too high. People will still buy. So this word I had coined, sell, regret and grow rich. So when you sell and the price goes up, after a while you regret at that time. When it comes down, you become rich. This is just one thing. But generally, we try to sell this kind of markets.
Got it.
Sorry, you asked the other question about the permanent bear market.
Yes.
I have not seen any in my opinion, if it is 1 year of bear market correction, I don't think is a bear market, because we are very long-term investors. We look at 5 to 7 years kind of thing. So 1 year of bad period is okay, but there was a continuous bad period from 1986 to 88 when VP Singh government was there and all that. So the government was not interested in anything on corporate growth or any policies where they were not interested at all, and prime ministers were changing very frequently. So as a result of that, that kind of a thing, 3 years continuously there was a bear market, 3 years or so. So that is a bear market, that's a real bear market. We have not seen one like that till now. I have not seen one like that. Every correction, every crash that has happened, it has rebounded in 6 months.
Got it. This one too seems like that only because there is political stability earnings in India. You think this will...
At present,
I'm just thinking...
I am extremely bullish.
You're extremely bullish.
I am extremely bullish.
Can I ask you, sir, you've seen the next generation of entrepreneurs through so many years. There was a next gen in 1980s, there was a next gen in 2000, there is a next gen in 2020s, right? Are you bullish on the current next gen of India Inc., of whatever limited number of companies that you may have seen? You may have interacted with some of them, you may have heard about some of them, you may have heard them in con calls, AGMs, etc. Are you bullish on some of the next gens, or is there a worry out there?
I'm quite bullish about them, a lot of them. And a lot of them are going into new age technology. A lot of them are also trying to, though they are in the old economy, they are looking at newer methods in the old economy. So I'm very bullish about the new gen.
Okay, Govind bhai, the next question is as much for an investor, maybe more for an investor, but maybe it applies to corporates as well. There is a need in a lot of people to be perfect as opposed to be good. I mean, you don't have to necessarily be perfect in investing because it's very difficult to time tops and bottoms, right? How do you think about it? Because I know you think very deeply about this.
I feel perfect is the enemy of good.
Why do you say
You have to be good, you don't have to be perfect as far as stock market is concerned.
Okay. Can you explain?
Because most of the people, they have, being perfect means you want to sell at the highest price and buy at the lowest price. So that is very difficult to achieve. Only if consistently somebody can achieve, he's God. So basically what we do is when we invest in the markets, we try to be good, not perfect. So when I feel that a stock is, we always try to trade in ranges. Either we sell in ranges or buy in a range, in a zone. So normally our, suppose I have a stock and it's going up, it has been going up substantially. Already it's become 2-3 baggers. I have a range to sell between 80 and 100, let us say, for example.
Which you bought lower.
Which I bought lower many years back or whatever it is. Now this particular thing, I will start selling at 75. And slowly I will keep on selling till I finish all the sellings. Maybe after 100 it may go to 110 also. But effectively my selling price will be, average price will be about between 80 and 100, maybe 85, maybe 90, like that. So similar thing is for buying. So you can't really get the best of the best because see there's so much of greed, when you own the shares, you don't want to sell. And so better to start selling early and let somebody else make money. It's very easy for me to say that, honestly. I also don't exactly 100% practice it, but I know this is the way you should do it.
Okay.
You should try to be good, not to be perfect. I also try other way, but it's a wrong thing to do, frankly.
Okay. Even in buying, Govind bhai, would be the same thing?
Buying, we will try to buy. See, buying today, what has happened is with the advent of internet, the markets have become very, very efficient from 80s, what I saw. So if the company is going to come out with a bad result for a quarter, and after that 2-3 years it's going to do very well, one should start buying much before the bad result comes also. Because when especially if it is not a very liquid stock, because if the bad result also comes, the market at that time, everybody wants to buy then. So you have to be a little ahead. So whatever you do in the market, whether buying or selling, you should be a little ahead of others. Only then you win. Because otherwise you will not get the desired quantity. When one quarter is going to be bad, people will keep on selling and you keep on accumulating. It's very easy to buy. You don't compete with so many people who want to buy. But once the bad result comes and market has started discounting much ahead, because with internet, everybody knows what is happening to, all the data are available, not only domestic, but even global data is also available. So it is always good to, buy it in this thing.
During the week time.
During a week period, when the markets are bad and going to turn around. You cannot do exactly, when it turns around, it will be very difficult to get the desired quantity.
Got it. Okay. Can I ask a follow-up on this, Govind bhai? Which is that, let's assume that there is a company that you've been freshly introduced to and you like it. And let's say, because you do staggered buying and range buying, you've bought a particular quantity, let's say 20 rupees, and your range is, let's say, 20 to 30 rupees. But by the time it reaches 30, if you wanted to buy 100 shares, you managed to buy only 30 shares. Then what do you do? Do you get a FOMO fear and do you buy the remaining 70 at 30, 31, 32, 35, or do you wait for it to come down, or agar niche nahi aaya, so it's okay, you'll play some other game?
See, you have to evaluate. Basically at 20 rupees, the range of 20 to 30 is too big a range actually. It should be 20 to 24. Anyways, so you have to assess at every point of time as you are buying, whether sometimes you feel that the market, you read that, it's becoming stronger and stronger with some foreign data and all that. Things are domestically, you do your research and find out there's better buy it off whatever you want to buy. Then you put up the price to up to 24 and buy it straight away, instead of buying gradually 21, 22, 20, 24. But if it's going to go to 25, 26 and all, you assess whether you will be able to still double your money in 2-3 years. Our criteria is to double our money in 2 to 3 years, maybe 4 years also. Because if you have bigger amount of money to be invested, it's okay if it doubles in 4 years, it's a lot. It's very difficult otherwise.
Yeah.
So if a good company is there which you have researched very well, you buy even little more than the range, only then when it comes down, suppose after you buy, normally it happens. After you buy, it may come down also, back to your range. At that time also you should buy. So you should not just stop your buying, if you like a company.
Okay. And are you a proponent of a high quality company being bought at a very high multiple or a price is also okay? Because the last 4-5 years, or maybe even pre-COVID, I remember this term BAP was coined, right, for a hypothetically a Bajaj Finance or an Asian Paints, that these companies are so good that you buy them in any price, and people made money for a long time. Then post-COVID, it has been true for the EMS sector, for select other sectors, that people bought them at a higher multiple. 50 multiple pe lene ke baad bhi the stock went up to maybe 70-80 multiples. How do you then, in your thought process, what kind of companies fit in then? Therefore, do you buy companies with a very high P multiple as well if the growth is strong?
No, you have to keep assessing, because see today, when I was young, in the initial days, you will give a maybe price earning multiple of 3 or 5 for a good companies.
Wow.
Okay, it keeps changing with the time,
Sure.
with the awareness, with the companies also becoming big. So even now you have to keep changing your thoughts. Change is only constant in life actually. So you cannot just be fixated in the stock market. You cannot just have one view that I will not buy anything more than 20 multiple or 40 multiple like that.
Got it.
You see relatively, you see how fast it's going to grow. Suppose some company is in deep trouble and there are 3 players and 1 player is almost gone, like we see in some electric vehicles, 2-wheelers and all that. So the other companies are going to do very well. So that kind of thing, then automatically the whole model changes for these kind of companies. So this is where we invest. But I don't agree that you buy at any price. No, never.
Never.
You should invest with a sleeping point. Whatever you buy.
Come to that,
Whatever we buy, we should be able to sleep with the investment. That what we have bought, at least after 2-3 years, the company should be there, which of course we buy only those companies. And secondly, we want to make sure that company has grown a little bit. If some of them may not come up to your expectations, or like they've grown in the past, they may not grow. But you cannot buy at any price. At the same time, you have to keep changing your thought process as it goes. So more and more research is required. on the company, on the promoters, on the general market participants also. I'm not saying market gossip, but market participants, you should good participants in the market, you find out why they are buying, those kind of things, and you can further understand that.
Yeah, like if you are buying, then people should try and understand
No
why is it
way,
that you
no
are
way,
buying.
no way.
Okay, but the other aspect of this, Govind bhai, is an important discipline therefore that might come here is letting go of things, much like cricket. A delivery outside the off stump, you let it go. How important is this letting go? Because you were talking about this crane example yesterday, if I'm not wrong.
I think, I feel that in the markets, see, for somebody like me, I'm like 44, 45 years I'm in the market. I have lots of friends all around, and they're all well-meaning friends. Everybody comes out with some idea or the other. In the stock market, you should be able to learn how to eliminate the ideas and focus on something. That is the most important thing, actually. Elimination is, if you don't do, then again you will get confused. You will lose your main focus on your quality investments which you have made. Others may also do well, but then it's better to let go that. So let going, that crane example, what we discussed. See, there's a story, when smart crane was there and all other cranes were there, and all the fish were coming and the small cranes were picking up the fish. The big smart crane, he didn't take any fish. When the others asked him, why you are not doing, he said, I'm waiting for the big one. So when he was asked, why don't you take the small one as a snack and take the big one as a meal? You know what he replied? He said, no. When I'm having the small one in my mouth as a snack, and that time suppose the big one comes, I don't want to miss the big one. So I'm waiting for that. So the process of elimination, even one cricket analogy also, Ravichandran Ashwin in the T20 match, he had only 1 ball and 2 runs to score.
This is the India-Pakistan
India-Pakistan
match.
T20, yes. And the ball was a white ball. And it was so tempting for anybody to go and run immediately. Virat Kohli on the other side was damn upset why he's letting go. But last minute, he thought he'll allow it to go. And he got a run. So he made sure that he's level. So same way in stocks, you should make sure that you don't lose. Then you will make money. You should know how much not to lose in the market when you invest. That is the most important thing.
Okay. So like everybody looks at, okay, if I buy this is the kind of upside that I will make. You are saying also what is very critical is knowing what is the kind of downside that can happen if things go wrong. As important, maybe more important.
Yes.
Wow.
Yes, that is very important.
Okay. And therefore, here's where, Govind bhai, the virtues of patience and discipline might come in, right? Because if you're letting go of things, you need to have the patience, because at some point of time, something will come by. And you need to have the patience for waiting for that.
See, honestly, I will tell you, very honestly.
Difficult.
No, I can talk, but in practice, I also don't do that. Let me make it very clear. It's not that, but everybody does mistakes. We also do mistakes. But this kind of patience and discipline are the most important things. When the markets go up steeply and people sell shares, and then they are not having any, discipline to keep cash with them. They are not having any patience to keep cash. They immediately want to buy. So that kind of a thing, you should try to avoid, because what people think is, if I sell this, what will I do with the cash? The first question they ask. The second question they ask is, if I sell this and I'll buy, if I get something good to buy, I will buy. Then I will sell this. Though he knows this is overpriced, he also goes and buys something else, which also will be overpriced because the market is overheated. So when the market comes down, even his share what he has sold has come down for him to be happy. But what he has bought also comes down. So the advantage there is to keep cash. So that is what most of the people don't do that.
And which is why maybe there is so much of literature on buying. The art of selling is, to your mind, as important or more important?
I think it's more important than anything else. Okay. The asset you have, at the end of the day, it's a paper asset. So you should know exactly to encash sometimes. You can't just keep, the underlying is good, but the stock price starts going up. When I buy a stock at 100 and my original target is it will go to 200. Suppose it goes to 200 in some time, and or is going to 150, I hear a lot of people talking about it, good things about it, and I'm very happy that the price is going up. I immediately try to target, put my revised target of 300. So that is a bad thing to do. Okay, that is not prudent. But you are so possessive because the stock you have bought and at 100 and it has gone to 150 and many people are talking about it now. So you feel it should go to 300, but no. You should try to do analysis whether it is really going to go to 300. If the answer is it may go to 300, definitely now circumstances have changed, then you hold on, you don't sell. Otherwise, you just brutally sell. If you feel that, okay, I don't get any more data point and it's gone too steeply in too short a time, you can sell and keep cash. So to a great extent, after our old experiences and old mistakes, we've learned little bit to keep cash. So that's why today's conditions, market conditions also, we are reasonably okay. Not that our portfolio has not gone down, it's gone down substantially. Okay, but we don't have to worry because we still have some cash left,
which you are able to use to buy.
Which we are aggressively buying now. We are almost reaching now 60-70% of our cash we have exhausted now.
Oh, okay. Yeah. Okay. Which means that in this current cycle, you are not very bearish because the street out there is divided. No. Some people are saying that bahut mandi hai. Some people are saying no, this is the bottoming out process.
See, one caveat is there. If the whole world crashes, then we don't know. I have been reading a book on crashes, actually, what happened in 1929 crash. So if something like that happens, then all bets are off. All assets will be down. But otherwise, I think valuations are much saner now compared to what it used to be earlier. Some companies, and you have to be very stock specific. I'm not saying all the companies or BCD companies, you keep on buying, like that. But some companies are coming down. So slowly we add those kind of companies. We are not very aggressive in adding.
Got it.
And Aram say we can buy, there's no hurry like that.
Govind bhai, can I ask you a question which is maybe pertinent to the current times as well? And a mixture of some of the things that you said, which is the 10% cash, etc. So if the market is going up, you could sell and you can make that 10% cash. I'm just saying, let's assume that you told me right now that if something bad happens globally, then all bets could be off. But at the same time, in the current context, you've put some money to work, let's say 50, 60, 70%. So in your mind, your belief is that the markets are likely to now head higher unless something bad happens. If something worse off were to happen, would you be comfortable creating a pool of 10% cash even at the current valuations, because market yahan se yahan pe aaya hai, you are believing that it might go up, but it doesn't and things become off. Are you happy creating a 10% cash at these levels as well?
No, because these levels we have got only 3% cash now.
Right. Would you create sell off and make additional cash here?
No, because we are in the bottom zone.
Okay, fine.
Of the market overall, in my opinion.
Sure.
And again, I want to tell your viewers that see, my viewpoint is 3 to 5 years kind of thing. So it is not that I am extremely bullish and people start buying.
Yeah.
We buy very quality companies, and which we know for sure. When I find an opportunity that there is going to be 110%, I'm confident that the stock will grow at 25%. I like to buy those companies with a good top class management. So that is the way we deploy.
Got it. And also because you are bottom up investors, so at times the macro may not really impact your investment decision as much if the valuations seem favorable.
Overall market crashes, everything will crash.
Agreed. No, but your buying decision is at times. So in a market crash, if a company comes down to your zone of valuations, you would be comfortable investing money into it even if the macro is not completely improved?
Yeah, we will wait. We will assess at that time.
Okay.
But we buy very stocks. We are stock specific. So the companies which we invest, we try to do more and more research about that.
Got it.
Okay. And the sectors generally, we don't really go to the new sector, but the companies which we know, we try to add more on that.
Got it. The other reason why I was pushing so much around this is because I've heard so much about you being a scared investor. You mentioned this at the start, and you mentioned that you don't want to lose money on an investment largely. So if you find a good investment as well, you take a platform, take it a small position, etc. So you are a very scared investor, which is I was trying to figure out how do you invest in such times when the market currently have scared everybody. Yeah.
See, eventually as of now, everybody is scared.
Yes.
Okay. So it is not that, people are not scared. People are much more scared. So sometimes somebody will take a lead, We have seen FII has been continuously selling. Suppose FII start buying, because globally, if you see, in US, the things are going, there is so much of turbulence. And suppose some money comes, it can only come to places like India, China, or maybe Germany, that kind of thing. And our rupee also has been, I think it's fairly valued. It can also appreciate also. And oil also has been reasonably okay. So all these are factors within our control right now. But tomorrow, if something happens and things go hayway, then all bets are off. You can't really take a call on that.
Okay.
So considering all those things, I think the market will slowly go up only, I feel.
Okay, but even when you're doing this or when you're thinking like this, there is something that you ask yourself, right? Because you told this to me that every investor should do that and you do this too, that why I might be wrong is a question that one should ask ourselves every single point of time.
Every time, because see, when you are decided to buy a stock, you are when you are almost making up your mind to buy. Okay, you read good news about the company, you get good commentary from all the TV channels and all that, and you also study the company you want to buy. But then, one thing you should know at that time is where I can go wrong. That is very important. I don't want to, maybe I may not make money, but I don't want to lose money. That should be your attitude. How much you will not lose at lower levels. So that is what we look at it.
Got it. Got it. Okay. Because cash for you is that bear market buying power. When you are selling as well, Govind bhai, do you ask this question to yourself that what if I'm wrong in selling this?
No, because I'm booking profits.
You're booking profits.
One thing. And second thing is, for selling also, we just don't sell because the price has gone up. We try to analyze whether, the company can still go, why it has gone up. Sometimes for wrong reasons the companies go up. And maybe the industry is going to be a sunset industry, suddenly. You find a lot of competition coming from China. What happened to chemicals 3 years back? And now solar also prices are coming down. So that way we look at that and then we take the call. We don't, take a straight away call like that.
Of course. Yeah, that I'm sure of.
So then we sell, after that we are convinced, then we sell the stock. And most of the times when we sell the stocks, we are selling, we have been holders for a very long time. So we sell the stocks and we are making profit only because they've been bought at much lower levels.
Got it.
And then keep that thing, so we had just put in our office this thing, sell, regret and grow rich.
Okay.
So in the bull market, in the crazy bull market, Harshad Mehta's time, we coined that thing and we put it in our office notice board. Sell, regret and grow rich. Because the way the market was going up, every day you sell, next day you regret. But eventually you see after things settle down, after the scam broke down and all that, you find that you have sold at a good price. So normally when people make money, they feel very good. But when they lose money, they feel even more bad actually. Because what they made, they are happy, they enjoy the money, everything is fine. They have a lot of plans for that. But when they lose money, it is very much more bad than you're having the thing.
Okay. Fair call. Since you mentioned about some themes, some sectors, I'm inclined to ask you, what is more important, an industry or a management?
I think a good management is most important. A good management, even in a bad industry, if it is doing badly, the good management will take steps. I know a company many years back when it was supplying to heavy commercial vehicle and there was big lull for next 1 or 2 years. During that time, they completely reduced their debt. They were gearing up for the next thing. So this is the quality of a good management in a bad industry, temporarily bad industry. But a bad management in a good industry, even if they make a lot of money, in the cycle is favoring them, how are they going to allocate the capital? Somebody may buy a plane, somebody will have a sister concern and put money there. All those things can happen. So always a bad management in a good industry is not as good as a good management in a bad industry. But at the end of the day, it is a good management that counts.
Okay, so good management over industry per se is the prime of thing.
Yep.
And which is why maybe a bottom-up investing. Okay, fair call. Going by you, I know you give a lot of importance to plant visits, management meetings, etc. One, what is the core reason for the same? Part one. But part two of my question is also this: not everybody's got the access to maybe visit a plant. Forget meeting a management also. So how do they? Let's say if this is important, how do they take advantage of something like this which they can't even have access to?
Plant visit and meeting management is one of the most important things, and you don't get an access immediately. We never got an access. You know, in 80s I went all the way, traveled to Hyderabad to and then Bangalore, and then 4 hours to Andhra to meet a chairman, and he said, "Have your meals and you can go." So it was tough in those days, meeting management. But over a period of time, they also know that you are a long-term investor and you ask the right questions, you know. And
in the AGM or
in the AGM. But today things have changed. Today the internet is there, first of all, for people to know, and then even most of the companies have these IRs, so you can always talk to an IR and get it. And now one of the topmost multinational companies, Wapco, I think in 3-4 days, maybe next week, they are arranging a plant visit for shareholders. So a lot of people do that. So you have to be a little proactive and try to meet. In the first attempt, nobody is going to say, okay, come, I will share with you everything and all. But over a period of time, they know the quality of investment you do, and they may help you like that, you know. And we don't want any management to tell us what is going to be your this quarter or next quarter or 1 year like that. We generally want to know what is the next 3 to 5 years plan of the company. The body language is very important when you meet the company people. In the AGM also, when you after the AGM, you know, those days physical AGM, people used to sit with the management and they will tell everything at that time. So that is one of the most important things.
Okay.
Sorry.
No, please finish.
And you know, it helps actually. This really helps actually, you know, meeting managements. So I feel that, you know, people should try to annual report, you have to read fully, and then you write to the IR that you have these questions and all that. And these days they arrange a lot of group meetings and all also like that, you know, to visit the plant. And people want to see the new age promoters, what we talked about earlier, entrepreneurs. They want to share with people what are our plans in future, you know. So that is very helpful. One example I can give you, you know, one management now, you know, Sundaram Finance, they have a condolence team with them. All the depositors are old people. People will trust Sundaram Finance more than Government of India.
Wow.
Yeah. Here, not only here, everywhere, you know. And all the depositors are very old people. If there is a death in the family, old man dies, immediately from condolence team, 1 or 2 fellows will go there. They will give condolences. They will ask the family if they need any help to get their insurance policy done and this done and that done. So all these things, you know, now if they have to, they will never change the deposit then. They will not go to somebody else who's giving 0.25% higher. So management basically who take care of the employees, who take care of the customers, who have good plans and who have good capital allocation, I think those managements are very, very good, and there are very few, but I mean there are many, but you know, you should really be able to understand which is a good management and not. It comes with a practice over a period of time.
Okay, going the last 3 questions on this. The first one is, like you said, when you started off earlier, building up the capital was also very important. You are at a stage now wherein capital is the least of your concerns, but at some point of time when you started off, building up the initial capital would have been as important as well, right? So how was that phase? Can you talk about that early part of your life of building up the capital? Because you've also been a stockbroker, you did it for a while, then you changed it. Any anecdotes that you can give us from there?
So, I mean, in the 80s actually there was no money. So I used to be doing a lot of trading.
Okay.
And idea was to just make money somehow, you know, and try to be a little smart, more smart than others to make money. And that trading, and then, you know, meeting companies, visiting plants, and, you know, I used to go to Bombay every day, meet 10, 12 people. I used to note down after meeting them what he said, like that, and then keep it in my mind, you know, because otherwise I'll forget. So it was good. Market was also very inefficient, so it was easy to make money. These days markets are so efficient, It's very difficult to make money actually. I'm really lucky. God's grace, I was there in 80s. So it is very difficult these days to make money like in those days.
Okay, very interesting. As you look back, Govind bhai, you've had a very successful investing career. I'm sure you're a very happy man per se by being in the capital markets. Surely there would have been some regrets. Are there any regrets as you look back? It could be a professional regret, it could be maybe a personal regret that stemmed out of the profession that you are in. Anything that you can want to talk about?
Professional regret is there, but the rewards are also there, so I can't regret much. I should have maybe built up a big organization like a couple of my contemporaries of those days. I didn't build up any big organization. I was busy making money. That reward has come, but I don't have a kind of a big setup like that. Personal regrets, I have lots of them actually. From 80 to 90, those 10 years of my life, I got married in 81, so those 10 years of my life, 10, 12 years of life, I was just going after, and children were being raised. So my wife Sandhya has done extremely good job in bringing them both up nicely, and both Chinmay and Ashish, my elder son, their wives also, both of them they are doing the same thing for their children, So Shreya is here and Manjari is in US. They are doing the same thing for their children, So which is a very heartening thing for me.
Okay.
But the regret for me, if I look back, is I should have also contributed there, to take care of the family,
Okay.
I used to go at 7 o'clock in the morning and come at 11 o'clock in the night.
Okay. So spending time with family, you think that's a regret as it stands right now in some sense?
I will tell the young guys today, have a little bit of work balance. Okay. You can't just keep endlessly going after this, because there is no end to this. This learning is an active process. You will keep on learning, So spend some time off and also do this.
Okay. Whether you are in the investing world or in a business or manufacturing, spend some time outside of work as well with your family.
With your family. That's very important, I feel.
Okay. This is great learning for me, Govind bhai, and thank you so much for that. My one last question is on India as you see it, because you've spoken a bit about the rupee and markets, etc. But as you look forward for the next 10, 15 years, because you are an avid traveler, you've traveled around the world, you looked at businesses so around, etc. Do you think the good part or a good period of India is, we've had some fabulous zones or fabulous years in the past. Do you think the next 10, 15, 20 years are very promising, or is it difficult to predict that in such a interconnected world?
I will give my version. It's very difficult in the interconnected world, you're right. My version is, energy prices are reasonably stable. Politically, we are pretty stable. And the government capex will start. They've actually started. It's already started. Private capex is yet to start. And there are very, very good entrepreneurs. There are very good new age companies, startup companies. I don't know much about them, deep tech and all that. But some of the companies are like unicorns, It would have taken 150 years for a company to reach 6,000 crores. And this fellow, young kid, in the last 3 years or last 5-7 years, he has become $1 billion company. So all that is very positive for India. So I'm very optimistic actually. I'm very, very optimistic. I think markets can correct, but at a low level, everybody is going to come and buy only. People have, all this new class of people, a lot of them have taken a beating, but then there is no better avenue for people to invest also. And there has been a very good wealth effect by real estate prices going up, by the mutual funds also doing so well. So I'm very positive and I'm very optimistic about this.
On that positive note, Shri Govind Parikh, thank you so much, sir, for talking to us. Really, really appreciate this. Thank you for giving us the chance to talk.
My pleasure. My pleasure.
No, I'm telling you, the pleasure was entirely ours. Thank you so much. And viewers, thank you for tuning to yet another episode of Talking Point Unfiltered.
Here at my firm, we look at investments in 4 buckets. Yes, no, too difficult to understand, and what does Govind Bhai say about these investments?
Of course, he's a very, very sharp investor and very astute investor. He's been investing now for more than 45 years.
Govind Bhai has often led from the front by introducing Dalal Street to a plethora of brilliant businesses, well-run companies in the South.
He's just such a wonderful human being, so unassuming, So kind, always so helpful.
I truly appreciate and cherish Govind Bhai's hospitality, thoughtfulness, and wisdom on investing, and the friendship that has endured for over 3 decades now.
If one were to write a chapter on India and then go towards South India, there's one name which would come absolutely on top of the list. It's our dear friend Govind Parikh.